Canadian Tire is up close to 30% year to date, but is still trading at a relatively low P ratio. So is it a good time or not to buy this stock right now? This is what you'll find in this video, where I'll make a full stock analysis on the company Canadian Tire with the ticker CTC. So as always, after checking their business model, so how are they generating their income and what have been their latest earnings reports, I'll make a quick fundamental analysis on this business, followed by a price prediction with different valuation models to determine what is the true intrinsic value of this company. As its name is saying it, Canadian Tire is a Canadian company that has been founded in 1922 in Toronto, and it has the objective to provide their customers from coast to coast with great innovative products. It is why now, with over 1,700 retail locations all across the country, Canadian Tire has been serving their clients for more than 1 century. From automotive to home, passing by pet care and snow removal objects, you can find almost everything in Canadian Tire stores. So it could be comparable with a big company like Walmart, but that is currently trading with a quite lower P ratio. In 2024, they have been able to generate some revenue of over $16 billion, and we can see that in their latest earnings report, they've been able to generate $4.2 billion of revenue for the quarter, a slight increase of only about 5.2% year over year. Unfortunately, we've also seen that their net income has been dropping year over year by about 7% due to higher expenses, plus its retail gross margin rate, so basically their total profit divided by their total revenue, have been declining to about 34.8%. This was primarily due to unfavorable banner sales and shipment mix during a period of Canadian dollar weakness. On a brighter note, we've seen that the big highlight of Canadian Tire for their latest earnings report has been that at the end of June, they've announced that their 54 store enhancement projects planned for 2025 have all been completed across 8 provinces and territories. And in total, their store enhancement that represent about $116 million of their operating capital expenditures for the first half of 2025. However, even if Canadian Tire stock has been performing quite well since the beginning of 2025, we can't say the same for the past 5 years, where it has only been returning about 10% of total return, while on its part, the total stock market has been returning over 90% of total return. Many factors can explain that, but one of the most important ones is the softening consumer demand, where we've seen that our total annual revenue have been dropping by about 6.3% between 2022 and 2023, because consumer spending in Canada has been under pressure via inflation, higher interest rates, and weaker discretionary purchasing during these past couple of years. Add to this, even if their total quarterly revenue have been growing quite okay over the past couple of earnings, we've seen that due to margin and cost pressures with rising costs in their supply chain and inventories, this has led them to have lower earnings in many occasions. But what remains a certain red flag for me in their business model is the fact that they are not only selling some essential products to their consumers, for example, products such as home goods and sportive goods, and at the same time, this business is only present into the Canadian market. Indeed, Canadian Tire, unlike some of their big competitors, is only based in Canada, meaning that they have some high exposure to the Canadian consumer demand and they have less exposure to the other international markets. So for me, it represents kind of a certain warning for the investors, because it kind of cut them a lot of potential growth that they could see potentially by going, for example, into the US market. But before to worry too much, let's now take a look at what the financial metrics and the valuation models are telling us about the true intrinsic value of this company. Over the past year and a half, the valuation of Canadian Tire hasn't been fluctuating that much, going from about $8 billion to slightly less than $9.5 billion right now. But the good news is that we can see that their price to earnings ratio has been massively decreasing from about 27 to about 11.57, while it remains with some pretty low and pretty good price to sales and price to book ratios. As I mentioned earlier, since the cost of everything has increased quite significantly these past couple of years, we can see that that their profit margin and their operating margin are quite low. Nevertheless, over the past 12 months, we can still see that they've been able to achieve a great return on equity of about 13%. During the same period, they've been able to generate some revenue of $16.69 billion with a slight increase in their latest quarterly revenue of about 5.20%, while unfortunately, as I mentioned, their earnings growth over the past quarter have been diminishing year over year by about 43%. Also, the company doesn't currently have a lot of cash on hands, only about $750 million compared to a total debt exceeding $10 billion, which makes that their total debt to equity ratio is quite high of about 155%. In terms of the volatility of the company represented by the beta on a 5 years period, we can see that with a beta of less than 1, it would mean that this company would tend to fluctuate slightly less compared to the overall market. And over the past 52 weeks, we can see that it has been returning slightly less than 10%, while on its side, the market has been returning about 2 times more, so about 16%. Canadian Tire is also pretty interesting for people looking for great income, where they currently offer an annual dividend yield of about 4.11%. And fortunately for them, we can also see that they are not using too much of their net earnings to pay the dividends to their shareholders, where they currently have a payout ratio of only about 48%. Now, to determine what is the true intrinsic value of this business, as always, we'll be using different valuation models, starting out with the Peter Lynch one, which is a simple formula where you add the future growth of the earnings per share with the dividend yield and that you divide with the price to earnings ratio. And so, knowing the fact that the company currently has a pretty low P ratio with a great dividend yield, it means that right now the company would be quite fairly valued. Unfortunately, since we can see that the average growth rate is bigger than our weighted average cost of capital, we won't be able to use a dividend discounted model to find the value of this business. But now for the third model, which is our discounted cash flow model, we'll simply discount all the future free cash flow of this company to find what is its enterprise value. The first step is to find what is the cost of debt, the cost of equity, and the cost of debt and equity to find what is our weighted average cost of capital. And with that, we can find that our current intrinsic value of this business would be of $209, meaning a slight upside potential of 21%. Finally, for the two last models that we'll be using, we'll first use the Graham's original value formula and the Graham's revised value formula. And in both cases, you can see that the current value of this company would indicate that this business would currently be undervalued. As you've been able to see in this video, according to every valuation models, Canadian Tire would currently be an undervalued company. With a super low P ratio combined with an excellent 4% dividend, this company might be pretty interesting for every investors looking for a great stable company that are paying great dividends to their shareholders. However, on my side, knowing that the company is only invested into the Canadian market, which is making that they are closing certain doors in terms of the potential growth that they could have by investing in other important markets, it means that it isn't a company in which I am looking to invest at the moment. But now, on your side, if you're looking to find what are the different companies and ETFs that I personally have in my own investing portfolio, well, you can check out the video that's gonna be right over here, and I will see you soon. Peace!